He has rich experience in advising various national and multinational companies across industry sectors such as fertilizer, real estate, hospitality, etc., in various aspects of indirect taxes. He also undertakes indirect tax compliance reviews, handles various assignments on devising tax efficient structures, and was a part of the domain expert team for GSTN. Now introducing our moderator for today's webinar, Mr. Rajiv Khandelwal ji. He is a fellow chartered accountant of the Institute of Chartered Accountant of India. He is also DISA ICI, a certified systems auditor. He is also an alumnus of Shri Ram College of Commerce, SRCC. He has over 3 decades of experience in compliance sector. Today, we are presenting a webinar on 50th GST Council meeting, navigating the changing GST landscape and insights. If you have any question during the webinar, please type them into the chat box. We will take the same at the end of the webinar. Now, without further ado, we will turn the time to our speaker. I now hand over to you, Rajiv sir, please.
Rajiv sir, please unmute yourself.
Hello. Now am I audible?
Yes, sir.
Yeah. So basically, this time also, this is the Golden Jubilee meeting of the GST Council. And as usual, they've come out with various pending issues which were pending for long. And they've come out with various clarifications. So we will just guide you as what have been made and what more issues have arisen because of those clarifications. So basically, a few rates have been changed. Like the one which will pinch you will be, that says will be applicable to all SUVs which meet the prescribed parameters. And a few items, the rates have been brought down from 18% to 5%, but I am not sure how many of you will be affected by those. And obviously, casino, house racing, online gaming, etc., will be taxable at a uniform rate of 20%. And obviously, the industry is up in arms, and every day we are reading news in the newspaper regarding the same. Let's see what happens. Then the council has also come out with various, like notification of GST appellate tribunal from the next month. And then GTAs will be required to file declaration for paying GST under forward charge only once by 31st March. There will be no need to file every year. Then also relaxations in filing of GST are 9 for the taxpayers. And even the scheme which was the amnesty scheme which was there for GSTR 4, GSTR 9, GSTR 10, etc. That has been extended till 31st of August, so that people can file the returns during till 31st of August, and lesser penalties will be payable. Then also various clarifications will be have been issued by the department. Already circulars are in place, and Tusharji and other experts will be talking about those in detail regarding refunds, regarding issues related to input service distributor, and various other things like services supplied by a director of a company to the company in his private or personal capacity, such as supplying services by way of renting of immovable property to the body corporate. It has been clarified that that's not taxable under RCM. Then various other clarifications which will be covered in detail. And also some measures to plug revenue loss, which is very important for the government, like implementation of eBay bill requirements for movement of gold or precious stones by the respective states, various amendments in GST registration because of various spurious and fake registrations being done, and the government has come to know about those with the various raids, etc., and surveys that they are doing. And then also system-based intimation to taxpayers in case they avail excess ITC in GSTR 3B vis-a-vis that is available in GSTR 2B above a certain threshold. So system-based intimation will be done, and the assessee will be asked to pay the tax or explain why the difference is there. So many things are there, and obviously the time is short. I request the speakers to give you the maximum insight in all these issues. So thank you so much, and I hand over to Tusharji. Thank you so much.
Thank you so much, Rajiv ji. Let me share the screen first. At the outset, I would like to thank Team Webtel for giving this opportunity. Friends, good morning to all. We have completed 6 years of GST implementation. 6 years is hardly a very short period of time in a life of a tax legislation. But I must say that within 6 years, we have achieved a lot. On the positive side, it's still one nation, one tax. We have uniform legislation, uniform procedure across the state. Second, to a large extent, the ultimate purpose of bringing GST, that was seamless flow of credit, that is avoiding cascading effect, that has been achieved. Though we still have certain issues related to blocked credit, etc. But to a great extent, we have achieved that. When we talk about the GST portal, it is working fine. If we see e-invoicing, e-way bill, all your reports of 2A, 2B getting generated from GST portal, it is working smoothly. Though in the initial period, we may have certain hurdles, etc. But the glow has matured, the portal has matured now. On the negative side, still we don't have tribunal. Still, these ARs and double AR, which is coming, creating a lot of confusion in the industry. Similarly, we are facing lots of amendments, lots of clarification, lots of changes every quarter. So we have to keep ourselves totally updated with all these amendments, all these changes. But friends, we must appreciate that some of these changes are actually very relevant for the taxpayers. The good thing is that policy wing, CBIC, the government is listening to the taxpayers. And no doubt in this 50th GST Council meeting, they have come out with various clarifications which are very beneficial for the taxpayers. So in this meeting, we will be discussing broadly all the circulars which have been recently issued by the government, along with the recommendations made in 50th GST Council meeting. The first issue which we will deal is with cross charge and ISD. Government have come out with circular number 199/11/2023, in which they have clarified in detail the concept of cross charge and ISD along with the valuation mechanism. So before we drill down into the circular, let us understand what is cross charge, what is ISD, and what was the tax position adopted by the industry, and what was the stand taken by the department. In fact, friends, department has, like, for example, various DGI authorities across India, even in departmental audits, etc. This concept of cross charge has come out and they have taken various positions. So we will be discussing what is the current scenario, and then we will discuss the impact of the circular. Cross charge, Schedule 1. It deems certain supplies which are even without consideration as taxable. It says supply of goods or services or both between related persons or between distinct persons as specified in section 25 when made in the course or furtherance of business. So if there is a supply of services between two distinct persons means every GSTN under the same pen is deemed to be a distinct person. It is treated as a different person from the perspective of GST law. Say there is a corporate office at Gurgaon, it has a separate GST number, and then I have plants across India, say Maharashtra, Chhattisgarh, having different GST number. So all these different GST number under the same pen is treated as distinct person, and any supply of services from one registration to another registration is deemed as service on which GST is payable as per Schedule 1. So practically the dispute which used to arise is that, like, there is a head office. What is the role of the head office in Gurgaon? The role of the head office is to provide support IT support, legal support, business support to the various registration. My IT team sit here, my legal team sits here, my tax team sits here, my management sits here. So this office is providing support. I request everyone to be on mute, please. So this office provides support to the various registration. Hence, there is a supply of support services by head office to my various other branch offices, various other plants, etc., on which there is a GST exposure. Similarly, there were various other kinds of transaction which were taking place. All these are basically internally generated services that is serviced by a registration to another registration under the same pen. Let me take an example of a logistics sector. I have 7-8 registration across various states. I am a transporter. I am paying my output at the rate of 12% on which credit is available. So from respective state, I am discharging my output GST liability at the rate of 12%. I had purchased 100 trucks. It's my fleets. I have purchased these trucks, say, in Haryana. So I have taken the credit of these trucks in the state of Haryana, but this truck is being used by 7 other registration also for giving output supply from that respective registration. Accordingly, there is a supply of provisioning of truck from head office, that is Haryana, to other registrations. Similarly, there can be a situation wherein manufacturer has sold the goods to the end customer from the factory directly, say factory situated in Maharashtra. But any warranty services in respect of those goods which are sold from factory in Maharashtra to the customer, say in Tamil Nadu, that Tamil Nadu customer comes to the Tamil Nadu service center, which is the part of my company and avails warranty services. In that situation, my Tamil Nadu service center is providing a services to the head office in Maharashtra. So there can be various situations wherein one office is providing services to the other offices. All these are known as internally generated services. So in all these cases, there was a taxability, and then the dispute was what would be the valuation in these cases. Friends, we are aware when we talk about valuation between related party or distinct persons, Rule 28 comes into picture. And one of the most important rule was the second proviso to Rule 28, which provided that where the recipient is eligible to full ITC, the value declared in the invoice shall be deemed to be the open market value. So we had this second proviso to Rule 28, which stated that if the recipient is availing full credit, then any value on the invoice will be deemed to be the open market value. So if head office is providing support services to the branches or the plants across India, then any value can be adopted if full credit is available. That was the second proviso to Rule 28 when read strictly. Full credit was not available. Generally, the perception of the industry was that we have to go into cost principle. We have to find out what would be the cost of providing such services and accordingly value our taxability. This was one concept of cross charge, and second was the concept of ISD, which was prevalent even in pre-GST regime. So ISD means input service distributor, which is just a mechanism of distribution of credit. There is a common services which you are availing at head office, but it is common to entire branches, entire plants, say statutory audit service. But bill will be one, so that vendor will auditor will raise the invoice at the ISD number, and ISD was supposed to distribute the credit to the various branches. So it was a distribution mechanism wherein I could have distributed the credit of a particular invoice to my various branches, various plants, because these services were ultimately consumed at various locations. So when practically what you these days, like what people used to do is that when we talk about the support services provided by head office to cross charge, the issue always arises. Should audit services be routed through cross charge or ISD mechanism? What about rental of head offices, maintenance of head offices, depreciation of assets, salary cost, advertisement cost? We used to take the trial of the corporate office and see whether the expenditure has to be cross charged or it has to be routed through ISD. Different practices were prevailing in industry. First practice was that which was based on the draft circular issued by the government, which they had later on withdrawn. That draft circular said that if services is common to various branches like audit service, routed through ISD mechanism. Second, if services are exclusively consumed at head office, say rental, maintenance, then that will form part of your cross charge. So there were a set of people who were undertaking cross charge as well as ISD. there was second category of people who were only doing cross charge and not doing ISD. There was third category of people who was doing ISD but not cross charge, and certain companies who were neither doing cross charge nor ISD. So different practices adopted by different taxpayers. DGGI has initiated investigation on the concept of cross charge across India. There, practically at various places, the authorities used to take the stand that all these support services provided by the head office to the branches, the valuation mechanism should be based on cost plus 10 principle. They are generally taking the trial balance of the client at head office, adding all the expenditure, and then adding a markup of 10% and trying to levy GST on such value. Whenever we used to argue before the authorities that there is a second proviso to Rule 28, which says that if full credit is available, then any value can be adopted. Practically at ground level, they don't consider second proviso to Rule 28 a real valuation mechanism. They simply ignore and go into cost plus 10% mechanism. So this is generally being faced by the taxpayers at various levels. Now, with this background, let us now understand the circular number 199, which has been issued by the government. And it is a very welcome step. We will understand this circular, what does this circular says, and then we'll analyze the impact of this circular practically. This circular has divided the entire concept into two parts. First is my common credit. That is, HO receive invoices in respect of common input services procured from a third party, but attributable to HO and BO or exclusively to one or more BOs. That is, for example, audit services, advertisement services. These are the services which you are availing from the third party vendor who charges GST, and these services are effectively used at various locations, not only at HO, but at various branches also. So they are consumed across India. This is one set of category, that is third party vendor providing services which are commonly consumed. And second category which they have made is called internally generated services. That is the services internally generated from one registration to another registration, like provisioning of truck from one state to another state, support services by head office to the branches. So these are internally generated services. So they have divided the entire circular into two parts. Coming to the first part, third party vendor services. Circular says that HO can avail the ITC of the third party vendor services and they can distribute it to the respective branch office or respective branch either through ISD mechanism or through cross charge mechanism. So all the third party services which are being received at HO, say audit service, advertisement service, etc., ultimately these services are consumed across India at various branches. So logically, credit should also be distributed at the various branches. HO cannot keep the entire credit within itself. It has to distribute to the various branches. So that mechanism of distribution can be either through ISD or through cross charge. If somebody has done ISD, that is also fine. If somebody has done cross charge, that is also fine. Now the circular has given blessings to either of the method adopted by the taxpayers in respect of third party services. Second is the internally generated services, that is support services provided by head office to the branches. In that case, circular has clarified that in case the recipient is eligible for full input tax credit, in that situation, the value of supply declared in the invoice by HO shall be deemed to be the open market value. That is, any value which I have declared on the invoice, that value will be deemed to be the open market value, and that is an acceptable value. Furthermore, circular, very important. Let me read the exact phrase. If HO has not issued a tax invoice to the BO, the value of such services may be deemed to be declared as nil, and such nil value shall be deemed as open market value. So even if no cross charge has been done by head office to the branches in respect of support services provided by the head office to the branches, and if full credit is available to the recipient, then the value declared, and even if no invoice is raised, then nil value is also acceptable. That is, you don't need to raise a tax invoice. Nil value is deemed to be in the open market value, and hence there will be no tax exposure if full credit is available. So that is what circular has clarified. And second situation, within internally generated services where the recipient is not eligible to take full credit. So where the recipient is eligible to take full credit, simple concept is that recipient is eligible, any value is acceptable. Even if no tax invoice is raised, nil value is also acceptable. Whereas if recipient is not eligible to take the full input tax credit, then in that particular situation, the circular has clarified that the cost of salary of employees of the HO is not mandatory required to be included while computing the tax value. So they have given a clarification that while valuing such services, you need not include the salary cost. So salary is not required to be included in either of the cases. So in respect of internally generated services, the circular has clarified that salary is not required to be included. To sum up, when we talk about the past period, at corporate office, I have various kinds of expenditure. One is my team is sitting there. I have my salary expenditure. I have my rental expenditure, maintenance expenditure. Then I have third-party vendor services, which I am availing at corporate office, say audit service, advertisement service, legal and professional services, IT services, SAP implementation service, so on and so forth. For the past period, in respect of internally generated services, nil value is also acceptable if full credit is available. However, in respect of third-party vendor services, that is IT service, legal professional services, audit services, which you have received at HO, that third-party services either need to be cross-charged or the credit of the same should be routed through the ISG mechanism as per circular. Now, the first interpretational issue which is coming out of this is that, okay, circular is beneficial to the extent for internally generated services, since my credit is available, even if I have not cross-charged for the last 5 years, no issue, nil value is acceptable. But what about third-party vendor services? I am a taxpayer, I have neither done ISD nor done cross-charge, but I have availed third-party services like audit service, advertisement service, legal and professional services at corporate office, and credit is also availed at corporate office. Based on this circular, can I say I am fully compliant, there is no tax exposure on me? Now, friends, if we see the circular, in respect of third-party services, they have simply said either the same should be routed through cross-charge or ISD mechanism. They have not discussed the valuation mechanism. For third-party vendor services, the circular is not saying that nil value is also a acceptable valuation mechanism. It is only in respect of internally generated services, the circular is saying that nil value is also an acceptable open market value. But if we see internally generated services, when they make a proposition that nil value is also a deemed open market value, provided full credit is available to the recipient, the same takes birth from second proviso to Rule 28. So to my mind, they have given blessings to second proviso to Rule 28 that wherever full credit is available, LU value can be acceptable value, including nil value. Now, for third-party services like audit service, advertisement services, third-party vendor services, I have neither cross-charge nor done ISD. As per circular, either I should cross-charge or do ISD. I have to adopt either of the mechanism. Let me go for cross-charge. Can I take an argument that circular is saying either you do cross-charge or you do ISD? Okay, I have opted for cross-charge. Now, since I have opted for cross-charge, ultimately I will be doing cross-charge under Schedule 1. If I am covered under Schedule 1, then ultimately second proviso to Rule 28, the valuation mechanism is also applicable on me. Can I take a stand that by adopting the circular, even for third-party vendor services, since I have opted for the cross-charge route, and in cross-charge, the same will be done under Schedule 1, and accordingly, second proviso to Rule 28 will be applicable. Can I say that since for internally generated services, government has given the blessings that second proviso to Rule 28 will cover nil value also, that should be equally applicable for this third-party vendor services also. So accordingly, nil value is also an acceptable value, and even if I have cross-charge at nil value, that should be perfectly fine even for third-party vendor services. That is one of the issue which we need to drill down. Friends, technically speaking, when we see the intent of the GST law, see, intent of the GST law that these third-party services like audit, advertisement, marketing, legal and professional, these are consumed across India. Since these are consumed across India, logically, the credit of the same should be distributed at respective branches, either through ISD or cross charge. So that is the harmonious or the logical interpretation. When we lead the law technically and literally, we may take an argument for the past period that since second proviso to Rule 28 has been given blessing by CBSE and it covers nil value also, though the clarification is applicable for internally generated service, but even for third-party vendor category, there also, if I would have opted for cross charge, and in cross charge, full credit is available to the recipient, nil value should be accepted. To my mind, that is a technical argument which is available to the industry. So in the light of this, we may contest even for the past period where the taxpayers have neither done cross charge or ISD. Based on this argument, they may even fight the case not only for internally generated service, but also for third-party vendor services. The second issue, which will have a big impact based on this circular, though this circular is in respect of transaction between distinct person, but what about applicability of this circular in respect of related party transactions? Friends, we are aware that government and like department like DGGI anti-evasion have issued notices to various entities in respect of taxation of corporate guarantee, brand name, secondment of employees, etc. So there are various transactions between related party which are without consideration, say provisioning of corporate guarantee by holding company to the subsidiary company. Department says that holding company is providing guarantee on behalf of subsidiary company to the bank. There is a supply of corporate guarantee services. Department is saying that if one entity is using the brand name of another entity, say my holding company has a brand name ABC. If my subsidiary company is also using the same brand name, there is a supply by holding company to the subsidiary company in respect of usage of brand name. Similarly, secondment of employees by my foreign company to the Indian counterpart. In all these cases, related party transactions, there is a tax exposure. We recently had Northern Operating System judgment wherein they said that provisioning of manpower by the holding company to the Indian counterpart is a supply of manpower services, and accordingly tax has to be paid. So in all these cases, department has issued notices, and most of the taxpayers, what we have seen, even if tax is paid, full credit is available to the recipient. So we are talking about a situation wherein for related party, government has issued a notice that holding company is providing corporate guarantee services to the subsidiary company. They should pay GST on this transaction, and recipient, that is my subsidiary company, is eligible to full input tax credit. At ground level, when we go and deal the matter with the investigation authorities, they never support second proviso to Rule 28. We always say, sir, full credit is available. Even if I opt 100 rupees, that should also be an acceptable value. But they always argue and say, no, we will not go by second proviso to Rule 28. We will go by some reasonable basis. Say you either take the percentage of the bank guarantee which you are availing, or apply 1%, 0.50 paisa. That is practically being happening at the investigation at ground level. Now, after this circular, when second proviso to Rule 28 has been given blessing, to my mind, the same will be equally applicable for related party transaction. So all these transactions of giving corporate guarantee to related party, brand name to related party, or secondment of employees, in all these cases, the benefit of this circular will be available, because this circular simply talks about second proviso to Rule 28 and says that where full credit is available, nil value is acceptable. So even though that clarification is applicable for internally generated service, that will should also apply equally to related party transaction. And based on this circular, we can make a proper response for all the investigations in respect of related party transactions, and say that since full credit is available, nil value is acceptable, even for secondment of employees, wherein the department is making an allegation to pay under reverse charge mechanism. You can argue and say, since full credit is available, nil value is acceptable. Even if I had not raised the invoice, no issues. This circular provides is beneficial to me, and it gives blessing to second proviso to Rule 28. And hence, to my mind, we can fully use the circular in all these ongoing litigation cases related to related party transactions. Further, friends, government in this council has also proposed that they would be amending the law to make ISG provision mandatory. So whatever we have discussed is for the past period till now, wherein for third-party vendor services, either ISG or cross-charge can be adopted. Further, for internally generated services, valuation is no more a dispute. Nil value is also acceptable where full credit is available. However, for future, the government will make the ISG provision mandatory, and accordingly, for all common services, the same would have to be routed through ISG only. We have to wait for the changes to be made in the law regarding ISG provisions, etc. So whatever we have discussed is applicable for the past. For future, we will have to wait for the amendment in the law. Now, moving on to the second issue. Recommendation on casino, horse racing, and online gaming. This recommendation is an adverse recommendation for the industry. Before drilling down into this recommendation, let us understand what was the dispute being going on. Under GST law, betting and gambling is taxable, and the valuation rules provide that the entire full value of the bet placed is taxable at the rate of 28%. Now, the issue arose in respect of online gaming activities. Department used to say that this online gaming activity is nothing but betting and gambling. Accordingly, 28% will be applicable on the full value of the bet placed. Taxpayers used to argue that this is not betting and gambling. This is in the nature of game of skill. Since it is in the nature of game of skill, it will not be taxable at 28% at the full value of the bet. Rather, say if I place 100 rupees at the bet value, 10 rupees is the platform fee charged by the gaming company. GST should be payable only on the 10 rupees and not the entire 100 rupees, because this is not in the nature of gambling or betting. This is in the nature of game of skill, and tax should be paid only on the platform fees. You all are aware about the 21,000 crore SCN in the case of Games Craft Technologies Private Limited, which has been cited down by the Karnataka High Court, and it has been held that online games are not betting, gambling, but a game of skill. Accordingly, tax is not required to be paid on the entire full value of the bets. Now, what government has done is that they have done away, what government is proposing is that to do away with this concept of game of skill versus game of chance. Now, there is no difference between game of skill and game of chance. They are proposing amendment under Schedule 3, wherein they will be taxing online gaming and horse racing. Everything will be included under Schedule 3, taxable actionable claims. Accordingly, in respect of online gaming, full value of the bet placed, if you are placing 100 rupees bet, entire amount will be taxable at the rate of 28%. So it is a very adverse impact for the industry, because this will involve a lot of tax on the bets which are being placed at the online gaming. And we will also have to wait and see the exact amendment, because practically there will be many challenges being faced by the industry. For example, I have placed 100 rupees of bet, 28 is GST. Okay, we will discharge 28 rupees as GST. Now somebody won, they placed bet of 100 rupees, they won 50 rupees. Effectively, now after winning, they are again placing a bet. So if they again place a bet, again it will be taxable at 28%. We have to wait and see how the law is amended. So this will also bring next set of dispute areas in future. Now moving on to the next amendment, which will be taken by my partner Chetan Agarwal. So Chetan, please share the screen. I will be stopping my screen.
Hello, friends. Now the next issue is regarding the mismatch of ITC between GSTR 3B and GSTR 2A. This is one of the most disputable matter, like the cross charge and ISD issues discussed by Tushar. So, what is the background? Background is with regard to this dispute is that since initially there was no GSTR 2A available to the taxpayers, and every taxpayers were taking ITC by complying the conditions mentioned in section 16(2), which prescribes certain conditions like the taxpayer should be in possession of tax invoice, taxpayer should have received the goods or services, the taxpayer have filed its return in GSTR 3B, then the supplier should have paid tax on the supplies made by him. These all conditions were there, and on the fulfillment of these conditions, the taxpayers were taking ITC. But subsequently, the government has made available this GSTR 2A form, and the department was started issuing notices claiming that ITC should be available only when the transactions are getting reflected in GSTR 2A of the recipient. For the initial period, there was no particular law or provision in either in the GST Act or in the GST rules. Subsequently, with effect from October 2019, they have brought a provision in the form of Rule 36(4) in the CGST rules, whereby they have provided that a taxpayer can claim ITC in respect of certain transactions which are not reflecting in their GSTR 2A, but to a certain extent. That limit was 20% of the total ITC amount that was getting reflected in GSTR 2A of the recipient. From 1st January 2020, this limit was reduced to 10%. Then further from January 2021, this limit was further reduced to 5%. And from 1st January 2022, they have amended the section and 16 and inserted 16(2)AA, whereby it was provided that ITC would be available only if the transactions are getting reflected in GSTR 2A or 2B of the taxpayers. So what we should first we should discuss the chronology. Initially, there was no provision, specific provision, which requires that ITC should be reflected in 2A, but there was a condition that tax should have been paid by the suppliers. That condition was from the very beginning. Then from October 2019, they imposes that restriction through rule, whereby they have restricted that 20%, 10% or 5% of the reported amount in GSTR 2A can be claimed as ITC. Then the taxpayers have started, or industry have started disputing this contentions of the department, saying that since there is no specific provision in the GST Act, so by rule, you cannot put additional restriction with regard to eligibility of ITC. So they have subsequently provided section 16(2)AA, whereby they have mentioned, brought this condition in the Act also. So now the assessment is going on, and the department is verifying the ITC of the since the inception of GST. For the first two financial years, for that is 17-18 and 18-19, the department has issued circular earlier dated 27th December. In that circular, they have clarified that there could be certain transactions in respect of which a taxpayer would have taken ITC, but that transaction is not getting reflected in their GSTR 2A. Therefore, effectively, the ITC claimed by a taxpayer in their GSTR 3B was more than what was reflecting in 2A. So the government has provided some relaxation in the form of providing certification. So the government has clarified through the circular that for these 2 years, if the taxpayer has taken ITC on the basis of some invoice which was not getting reflected in 2A, the taxpayer should and give a certain certificate to ensure that tax was actually paid by the supplier, because of his certain errors or non-filing of GSTR1, that transaction was not getting reflected in the GSTR2A of the recipient. So basically there could be certain scenarios like the supplier would have mentioned wrong GST of the recipient, or may have filed 3B but may not have filed GSTR1, or may have reported those transactions as B2C transactions instead of declaring it as B2B transactions. So in those cases, tax was paid by the suppliers, but it was not getting reflected in GSTR2A. So if the government has provided that if the difference between the ITC available in 3B and ITC available in GSTR2A vis-a-vis a particular supplier is more than 500, that is the difference of ITC in respect of a particular supplier during a financial year exceeds 5 lakh rupees. In that case, the recipient can take a CA certificate from supplier certifying that the taxes on those supplies have been paid by the supplier to the government, and there was actual supply of goods or services underlying those invoices. And if the difference was less than 5 lakh rupees vis-a-vis a particular suppliers, that certificate can be provided by the concerned supplier only. Now, dispute started arising that whether this benefit of these clarifications would also be applicable for the subsequent financial years like financial year 2019-20, 2021 and 21-22. Whether these clarifications would also be applicable in these cases. So now the department has come up with another circular whereby it has clarified that till 8th October 2019, Rule 36(4) was not there in the GST legislation. So till that date, benefit of earlier circular would be available. From 9th October 2019, Rule 36 was introduced, and till 31st March 2020, 31st December 2019, the restriction imposed by Rule 36 was 20% of the ITC appearing in GSTR2A. This limit was again reduced from 1st January 2020 to 31st March 2020. 31st December 2020. There was this limit was reduced to 10%, and from 1st January 2021 to 31st December 2021, it was 105% of the total ITC appearing in GSTR2A that a recipient was eligible to take or claim. Now the department is saying that for the first till 8th October 2019, you can take benefit as it is provided in the earlier circular. And with regard to this period during which Rule 36(4) was applicable, during that period, you can take benefit of that circular, but only to the extent of the ITC allowed by this provision, that is Rule 36(4). That means, for example, if you have taken ITC of 1 lakh rupees that was reflecting in 2A, but you have additionally taken ITC of 20,000 rupees during the period this up to October 2019 to 31st October 2019, 20,000 extra, which was not appearing. So total ITC you have taken is 120% of the ITC appearing in 2A. In that case, you can take that benefit. But if you have taken more ITC, that is ITC more than 120% of the ITC reflecting in 2A, then benefit to such excess ITC will not be available. We can discuss this with example. Suppose for the period of 9th October 2019 to 31st December 2019, as per GSTR 3B, ITC claimed was 5 lakh rupees. As per GSTR 2A, ITC available was 3 lakh rupees. Relaxation provided during this period wide rule 36(4) was 20 lakh, 20%. So ideally, the taxpayer could have taken ITC 3 lakh plus 60,000. That means 3,60,000 rupees the taxpayer could have taken as per the provisions of rule 36(4). But he has claimed ITC of 5 lakh rupees. So here the taxpayer has claimed 1,40,000 excess ITC in respect of excess ITC than what was allowed by the rule 36(4). So the benefit of earlier circular could be taken only to the amount of 60,000 rupees. That means up to 60,000 rupees he can take certificate from the supplier, and for 1,40,000 rupees that benefit would not be available. So in this case, what is happening, that department is imposing double condition. First, irrespective of the fact that there was no provision in the act earlier, before introduction of 16(2)AA, there was no provision in the act for taking ITC on the basis of 2A or 2B. So they have imposed their condition that you can take ITC or certain restrictions with regard to 20%, 10% or 5% of the caps. That is that was already under challenge before various high courts. And then again they are capping this restriction that that amount should also be paid by the suppliers. Tax on those supplies should be paid by these suppliers. So in this case, they are imposing double restriction. First, there was no provision under the act. We are already disputing those matters in various high courts. And second, they are imposing additional condition of providing the certificates from the suppliers. So even after this circular, the taxpayers can take benefit to the extent they can avail for the remaining amount. That means the amount which was in excess of the ITC permitted by rule 36(4). For that purpose, they can still argue in the court that the rule 36(4) was constitutionally invalid because it was a fault of supplier and not the fault of the recipient, or for taking other arguments like the department cannot deny credit unless and until some collusion is proved between the supplier and the recipient. So that contention which we were taking earlier is still be taken for still can be taken for this period. Next topic is regarding the interest on wrong availment and utilization of IGST ITC. So in this case, currently what three kinds of ITC is available to a taxpayer: IGST, CGST and SGST. And as per the GST provisions, a taxpayer has to first utilize IGST ITC against the liability of IGST, then and CGST and SGST, then it can utilize CGST and SGST ITC. So sometimes it may happen that the taxpayer may have availed some IGST ITC wrongly. In that case, the taxpayer would be liable to pay interest on the IGST credit availed wrongly if he is utilizing that wrongly availed credit from the date of utilization. But there could be a situation that the taxpayer have utilized IGST ITC, but there was balance in the CGST and SGST credit ledger from the date of utilization till the current date also. So various representations made before the government, whether in this case, even if the taxpayer is having balance in their CGST and SGST credit ledger, they are required to pay interest in respect of IGST credit wrongly availed and utilized. In this case, in respect of this, the department has given a clarification that interest is not required to be paid in respect of IGST wrongly availed and utilized if the total amount of ITC available in the electronic credit ledger with respect to IGST, CGST, and SGST in total is more than the amount of ITC, equal to or more than the amount of IGST, ITC wrongly availed and utilized by the taxpayer. Or there could be a scenario that suppose you have the taxpayer has wrongly availed ITC, IGST, ITC of 50,000 rupees, but there is a balance of CGST and GST credit ledger of 25,000 rupees. So the interest liability would arise only on the differential amount. In this case, two further issues arise. Since the government has provided that since CGST and GST ITC can be used for payment of IGST, so whether this benefit can be extended for CGST and SGST. That means if there is balance of IGST in the credit ledger and the taxpayer has wrongly availed and utilized CGST ITC, so whether that balance of IGST credit can be considered for determining the interest liability of CGST or SGST, but the government has not provided relaxation for that. Second point that would arise here is in certain cases department is raising demand with regard to wrong availment and utilization of IGST credit. So in this case, whether in some cases the taxpayers have discharged this liability through utilizing CGST and SGST credit, but department has denied this payment, citing that since the wrong availment and utilization was of IGST credit, you should have reversed the ITC only through IGST credit. So whether in this case, when department has accepted that and taken the this balance of CGST and SGST at par with IGST, so whether this through this clarification now that liability can be discharged through CGST and SGST, and whether department can still dispute this discharge of tax liability utilizing CGST and SGST. That is still to be seen. Then the department has provided this benefit of consideration of CGST and SGST for IGST interest liability, considering the fact that CGST and SGST credit can be used for making payment of IGST liability. But in case of compensation cess cannot be utilized for making payment of IGST, CGST, and SGST liability. Compensation cess can be utilized only for payment of cess liability on supply of goods and services. Therefore, the department has clarified that while determining the interest liability in respect of IGST, balance of compensation cess would not be considered. Then next issue is multiple e-commerce operator in single transaction. As per section 52, when a supplier is supplying goods or services through an e-commerce portal, who is also collecting payment on behalf of such suppliers, is liable to deduct TDS and deposit to the government while making payment to the supplier. Now, certain confusion arises in the industry where multiple e-commerce operators are involved. So the government has come up with certain clarifications mentioning two scenarios. First scenario is where the first person involved is buyer, second is buyer side e-commerce operator, third person is supplier side e-commerce operator, then fourth is supplier. Here 4 persons parties are involved in this transaction. Buyer will raise its requirement to buyer side ECO, then buyer side ECO will forward that requirement to supplier side ECO, then supplier side ECO will forward that requirement to the supplier, and then supplier will make the supply. In this case, the question arises whether who will be liable to deduct this TDS and deposit to the government, whether it should be buyer side ECO or it should be supplier side ECO. here it is clarified that where the supplier side ECO is himself not a supplier, but just facilitating the supply. So in this case, the supplier side is the person. Supplier side issue is the person who would be making payment to the supplier. So ideally, he should this supplier should deduct the TDS and deposit to the government. In the second scenario, there are three parties involved. First is buyer side ECO. Third person is supplier, who is also an ECO, electronic commerce operator. In this case, three parties are involved. But in this case, what is happening that the buyer side ECO is making the payment to the supplier, who also happens to be a electronic commerce operator. So TCS liability arises on the electronic commerce operator who is making payment to the supplier. In this case, buyer side ECO is making payment to the supplier. So the buyer side ECO would be liable to deduct TDS and deposit to the government. Nowadays, the department is also issuing notices and raising disputes with regard to this shares held by the subsidiary company, holding company in the subsidiary company, citing that such activity of holding shares by the holding company in the subsidiary company is mentioned in the scheme of classification of service under SSC entry 997171. There it is provided that the service provided by holding companies, that is holding of securities in companies and enterprises for the purpose of owning a controlling interest. So by citing this entry, department is contending that the holding company is liable to pay GST in such cases. So now, to avoid this dispute, department has come up with the clarification that shares are not goods or services, and mere holding and mere mentioning of this entry in the scheme of classification would not convert this into a supply of service. Therefore, no GST is applicable on this. GST can be applicable if there is some underlying services provided by the holding company to the subsidiary company. Transaction during warranty period. This clarification will provide a great relief to the manufacturing industry, in which the manufacturers are providing post-supply warranty to the customers. This will majorly affect the auto industry. So in this case, what was happening, that department where the manufacturers sells the goods to the customers through distributors, at the time of supply, it provides certain warranty to the customers, and subsequently, if some problem get triggered in that particular product, they can bring those product to the service center of the manufacturer. There they can get the product repaired, and if any part is defective, then that part is replaced on free of cost basis. Department is, in certain cases, department is saying that GST is applicable on this replacement, and in certain cases department is denying ITC with respect to such parts. So now the government has come with certain clarifications with regard to these transactions. First scenario is supply by way of replacement of parts and repair services directly by the manufacturer to the customer. In this case, if the manufacturer is directly replacing that part of the customer's product, so directly, in that case, no GST would be applicable, because it is as per the industry practice that the original price of the product ideally includes the warranty cost. The company already predicts that a certain amount would be, expenses need to be incurred during the warranty period. So they factor this thing in their pricing accordingly when they are providing this replacement service during the warranty period. And if they are not charging anything, any consideration from the customer, no GST is applicable. And if the manufacturer is charging some additional consideration, then GST would be payable on that consideration charge. Then next scenario could be if this replacement or warranty service is provided by the dealer or distributor of the manufacturer to the customer. In that case, there could be again different scenarios. First scenario is the dealer or distributor would be having stock of that part that need to be replaced in the product. So that could be owned by him, or he can the dealer can procure from some third party. So in this case, replacement of such part using his own stock or by procuring from third party would be considered as supply by the dealer to the manufacturer, because the dealer is replacing this part on behalf of manufacturer to the customer. So in this case, dealer it will be considered that dealer is making supply of those parts to the manufacturer, and dealer will discharge GST liability on the same, and the manufacturer would be entitled to claim ITC of such part replaced by the dealer. Second scenario could be issuance of requisition memo. So in certain scenarios, what happens that when a particular product, customer bring a particular product to the dealer or service center of the manufacturer, in that case, the service provider who is undertaking the warranty this activity, he first identifies which all parts are required to be replaced. After that, dealer issues the requisition memo to the manufacturer, and manufacturer provide that part on FOC basis to the said dealer. In this case, no GST is payable because manufacturer is supplying those parts, the cost of which would be already factored in the original price at which the product was sold to the customer. So there is no GST liability. And secondly, the manufacturer is also not required to reverse ITC on this transaction. Third scenario could be there could be some stock of these parts already available with the dealer, which he has procured earlier from the manufacturer. So in this case, the dealer make replacement using this parts, and subsequently the manufacturer issues GST credit note as prescribed under section 34(2) to the dealer. Manufacturer is, as per the clarification, manufacturer is entitled to adjust this tax liability from in his GST return, but with the condition that ITC in respect of this part should be reversed by the dealer. Then the third scenario is repair service by dealer to the manufacturer. In case the dealer is repairing this product, but also charging some consideration for the services, not for the part, from the manufacturer, in that case GST would be payable by the dealer on the service charges being recovered from the manufacturer, and manufacturer is entitled to claim ITC of this GST charged by the dealer. So here certain issues arises, like that in case the department has already provided that the dealer can also replace the goods from its own stock, and in that case manufacturer has to issue the credit note under section 34(2). But in our view, there could be we should also consider the recent judgment of Tata Motors, wherein recently provided by the Supreme Court, wherein it has held that credit note issued by the manufacturers to dealers for replacement of parties consideration, and dealer is required to pay sales tax on these cases. So what is the issue here is, as per section 34, credit notes can be issued for certain particular situations, like where is sales return or some higher amount was charged on the tax invoice, or there was some discrepancy in the supply. In all those situations, a supplier can issue credit note. So here might be department has construed this transaction as sales return, where the dealer is using parts available in its stock for replacement. But in our view, this should not be considered as sales return transaction. And this is more so in the light of Tata Motors, because in this case already the ownership of those parts were transferred from the manufacturer to the dealer, and dealer is using those goods for effecting the warranty transactions. So in that case, ideally the taxpayer, the dealer should have raised tax invoice on the manufacturer, and manufacturer can issue a commercial credit note as a consideration to the dealer, as stated by as observed by the Supreme Court in the case of Tata Motors. Then second scenario is regarding the issuance of requisition memo. There could be two situations. One, as envisaged in this circular, that when a particular customer is coming to the dealer for repairing, then before repairing, the dealer issues requisition memo to the manufacturer, and after receiving those parts on FOC basis, the dealer repair make the replacement. That scenario is covered in the circular, and it is the clarification provided by the government appears to be correct. But there could be another scenario where the dealer is firstly replacing the goods from its own stock, and thereafter it is issuing the requisition memo to the manufacturer, and then manufacturer is then providing that part to the dealer for in respect of parts replaced. So in this case, what we can see that the dealer is not using the parts provided by the manufacturer for replacement, but he is first using his own parts and subsequently using getting the part from the manufacturer. So in this case, in our view, can be construed as barter transactions, where therefore in this case both the dealer and the manufacturer should raise tax invoice on each other. The dealer should raise for the invoice for the part replaced, and manufacturer should raise invoice for the part given as a replacement to the dealer. Then the next clarification was issued regarding the refund related matters. So the first issue is regarding amendment in section 16(2)AA. So earlier in case when a taxpayer is claiming ITC refund in case of export without payment of tax, that refund is available only in respect of those ITC which are getting reflected in GST 2A of the taxpayer. But now GST 2B is implemented, so there was doubt in the industry that whether the ITC should be reflecting in GST 2A or 2B while claiming the ITC refund in case of accumulated ITC refund. So the department has clarified that since GST 2B was made applicable with effect from 1st January 2022, and the taxpayer want to claim refund for any tax period after that 1st January 2022, the ITC should be available in GST 2B. So it should be verified from GST 2B and not GST 2A. But if any taxpayer has already applied for that refund for the period from effective from 1st January 2022 on the basis of 2A, such cases should not be reopened. That has also been clarified. Then second clarification is regard to the computation of adjusted total turnover. Earlier, the department has issued explanation to Rule 89(4), whereby it says that value of exported goods shall be the lower of FOB value declared in the shipping bill, or the value of declared in the tax invoice. Lower of the lower of these two values shall be considered as value of goods exported out of India. So in this case, what department is doing when the taxpayer is making application for refund, so the export turnover department is considering as per this explanation, but the adjusted total turnover to be determined for this formula, for that purpose department is not considering this explanation. They are, it's for this purpose now the clarification has issued that when this explanation is being used for calculating the value of goods exported out of India, the same value should also be considered for adjusted total turnover. Then the third clarification which is issued regarding export related matter is, as per rule 96A, the goods should be exported within 3 months from the date of invoice. And in case of export of services, the payment in respect of services exported should be realized within 1 year from the date of invoice. If these compliances are not done, then in that case, the exporter who has claimed refund of accumulated ITC has to pay tax on the goods which are not exported within 3 months from the date of invoice, or if payment is not realized within 1 year from the date of invoice. But now the department has started raising demand because claiming that you have not adhered with the provisions, timeline compliances mentioned in Rule 96A. Therefore, you are liable to pay tax. So the taxpayers are making payment of tax because of non-compliance of these transactions. But subsequently, there are certain cases in which goods are exported or payment were received by the exporters. So ideally, the compliances were not done within the time frame, but were subsequently complied. So in that case, the government has clarified that the substantial benefit provided in respect of export transactions cannot be deprived from the taxpayers merely on the basis of some compliance procedure. Therefore, they have clarified that if the exporter is complying with this requirement of Rule 96A subsequently, then the exporter will be entitled to claim refund of IGST, which he has paid on non-compliance of Rule 96A. Matlab that is not paid if for example, the exporter has not exported the goods within 3 months from the date of invoice, then he has paid the tax IGST on that goods. Subsequently, the goods were exported. Then in that case, the exporter claim refund of that IGST paid. However, the exporter will not be allowed to claim refund of interest paid in non-compliance of Rule 96A. Such refund application can be made under the category of excess payment of tax. However, some changes in this regard is required to be made on the portal. Therefore, till these changes are made, the refund application can be filed under the category any other on the GST portal. As per the GST provisions, a registered taxpayer is required to issue e-invoice in respect of B2B transactions where the turnover of the supplier exceeds the prescribed threshold limit. In certain cases, what is happening that certain government department or establishment or government agencies, local authorities and PSUs who are the recipient, were registered only for the purpose of deducting TDS from the payment made to the suppliers. They are not required to register as a supplier, but they have obtained registration solely for the purpose of deducting TDS. So in this case, clarification has been issued that e-invoice is mandatory in this case also. So if any supplier is making some supply to the government or PSUs or local authorities who are registered solely for the purpose of deducting TDS and not for discharging GST liability as a B2B supplier. In that case also, the supplier has to generate e-invoice in respect of supplies made to such recipients. Amnesty scheme. From time to time, generally government brings some amnesty scheme to regularize the non-compliances from the taxpayers. So there were certain compliances in respect of which the government has brought this amnesty scheme to provide amnesty from late fees or penalty. Wide notifications, various notifications dated 31st March 2023. So through these notifications, government has provided that in case of non-filing of GSTR 4A, GSTR 9, GSTR 10, or maximum, the government has capped the maximum penalty to a certain amount if these returns are filed by 30th June. So in case of GSTR 4, the government has provided that if the taxpayer is filing GSTR 4 by 30th June for the period from beginning from 2017 to March 2022, then in case of nil return, the late fees would be nil, and in other cases, maximum late fees would be 500. Then in case of GSTR 9, if the GSTR 9 for the period from 17-18 to 21-22 is filed by 30th June 2023, then the maximum late fees applicable would be 20,000. In case of final return GSTR 10, it was mentioned that if it is filed latest by 30th June, then the late fees would be restricted to 1,000 rupees. Then there were certain cases where registration was cancelled for the reason of non-filing of returns. So if the registration was cancelled on or before 31st December 2022, the taxpayers were given a time that you can apply for this revocation application till 30th June after making payment of all the due taxes and penalties. That time was provided. Then in certain cases, department were conducting best judgment assessment under section 62 in case of non-furnishing of valid form GSTR 3B. So if the taxpayers has not filed GSTR 3B returns, then the department were doing best judgment assessment under section 62. So the department has earlier provided a relaxation that if you are filing all those returns along with payment of due taxes and interest and late fees up to 30th June, this assessment order will be deemed to be withdrawn. So now the department has again extended this amnesty scheme till 31st August 2023. So if the taxpayers are making these compliances till 31st August 2023, the relaxation which were provided earlier, wide notifications dated 31st March 2023, will get extended up to 31st August 2023. In the GST Council meeting, the council has made recommendations regarding certain other things, but the clarification or circular is still awaited. One such clarification is with regard to the food and beverages supplied in the cinema hall. So the cinema halls are supplying this food and beverages, and that can be supplied in two manners. One is along with the price of the ticket, and second is separately in the cinema hall. So the industry was considering it as a restaurant service, and were intended to discharge GST at the rate of 5%. However, department was of the view that no, this is not a restaurant service, so you are liable to discharge GST at the rate of 18%. This was an industry-wide issue, and the industry has represented before the government. Now the GST Council has recommended that in case the food and beverages are supplied in the cinema hall separately, that is not as a part of price charge for the tickets, cinema tickets. In that case, such supply of food or beverages should be considered as supply of restaurant service, and the GST rate shall be 5% in these cases. However, where the food and beverages are supplied as a part of cinema ticket, in this case, it will become a composite supply, and on the entire transaction, that is amount of ticket plus consideration charge for food and beverages, on the entire amount, GST would be applicable at the rate of 18%. Then GTAs are provided. Earlier GTAs, the supply of GTA was chargeable under reverse charge mechanism. Then subsequently they have provided the GTAs with the option to discharge GST liability under forward charge mechanism. For this purpose, the GTAs are liable to file a declaration every year till 15th March of the preceding financial year. So suppose for 23-24, if the GTA want to discharge of GTA want to offer forward charge mechanism, then it was required to provide a declaration that it wants to get a discharge GST liability under forward charge by 15th March. But now the department, because it was a cumbersome exercise, and in certain cases the GTA might forget to file such declaration, and because of this clerical error, there can be huge implications on the GTA, because it is also not very organized sector. So now the government council has recommended that if once GTA has filed a declaration once to discharge GST liability under forward charge, then such declaration would be applicable for all the subsequent financial years, and this option will change only if the GTA is filing subsequently that they want to revert to RCM. So now they are not required to file declaration every year. If the GTA has filed declaration once that it want to offer forward charge, this position will continue, and it will change only if the GTA is filing a declaration subsequently to revert to RCM. And the date for exercising this or making declaration is also proposed to be extended from 15 March to 31st March. Then supply by directors. So services supplied by directors of the company is covered under the reverse charge mechanism. Therefore, the company is liable to discharge GST liability in respect of the services provided by the directors. However, there are certain services which are provided by the directors, but they're in their individual or personal capacity. Like in some cases, the directors are providing some residential property on rent to the company. So the department intended to recover GST liability on this activity under RCM from the company. So this issue was already raised in the case of Court Cables Industries Limited before the Delhi Tribunal, wherein the tribunal has held that there are two categories of services. One is director services, another one is services which are provided in the individual or personal capacity. So the RCM liability should attract only in respect of those services which are provided by the directors in the capacity of director of the company. RCM liability should not be imposed in respect of the supplies or services which were provided by the directors in its individual or personal capacity. In case the director has provided any property on rent to the company, that is not provided as a director but in the individual capacity. Therefore, in that case, GST liability, oh sorry, service tax liability should not arise under RCM. So now the department has also clarified through the circular that the services which were provided by the directors in his personal or private capacity are not taxable under RCM. However, if the total aggregate turnover of the director of the company is more than 20 lakh rupees, then the director has to provide discharge GST liability under forward charge in respect of such supplies. With regard to the residential property, it may also be noted that if the director is providing some residential property in its individual capacity to the company, then that transaction is even otherwise specifically covered under RCM mechanism. So if the director is providing residential property to the company in its individual capacity, then the company would be liable to discharge GST liability in respect of that residential property because of the specific provision. However, if the director is providing some other services or making other supplies in its private or personal capacity, and the liability, company would not be liable to discharge GST liability under RCM in respect of those service supplies. Then another recommendation that's made by the GST Council in the council meeting was that in case of supply of taxable services through or by the ECO, if some taxpayer is making taxable supply of taxable services through or by an ECO or by a supplier of ODR service to the unregistered recipient, then they are required to issue tax invoice, but that also requires to mention the name. As per the current provision, the supplier is also required to mention the name and address of the recipient. But considering the nature of electronic transactions, it may not be always feasible to obtain the complete address of the recipient. Therefore, the council has recommended that in case of supply of taxable services through or by ECO or by a supplier of OIDR services to the unregistered recipient, full name and address of the recipient is not mandatory. Only the name of the state of the recipient shall be mentioned. Then again, in case of OIDR services, so second clarification proposal they have provided in this council meeting is that in respect of OIDR services provided to the registered taxpayers, that OIDR service providers are located in non-taxable territory and they are providing these services to registered persons located in the taxable territory. In that case, they have to provide the details of these registered persons in the form 5A they have to file, through which the department can track the RCM liability of such registered persons who are receiving the OIDR services. Then relaxation in respect of annual filing of returns for the financial year 22-23. So the government, considering the hardship of the taxpayers, the government has provided certain relaxations in respect of annual returns for the earlier financial years, like the non-declaration, non-reporting of HSN codes for inward supplies, then refund details, demand details. There are certain fields for which they have already provided option because this was not very, the taxpayers were not very comfortable or were having this data to be reported in the GSTR 9 and 9C returns. So the government has, it has been proposed in the council meeting that the relaxation provided for the earlier financial year 21-22 will also be continued for GSTR 9 and 9C to be filed for the financial year 22-23. Then the next proposal made by the council was regarding providing exemption from filing of annual returns. So earlier exemption is provided to the taxpayers having 2 crore rupees from filing GST 9 and 9. That exemption will continue for the financial year 22-23 also. So all this from our side. Thank you. Now we can take the question and answer.
हेलो नितिका जी
Tushar sir, I request you to please take the question answer session. Yes, sir. Tushar sir, I request you to please take the question.
The next question is the bank guarantee valuation which we have to take in case of corporate guarantee. See, practically what is happening is that in case of valuation of corporate guarantee, generally the bank guarantee which is taken by the company department is taking that as the base for valuing the corporate guarantee. If company has taken bank guarantee can be of various types. Some bank guarantee can be based on an FD backed bank guarantee. Some can be non-FD backed bank guarantee. So there are various kinds of bank guarantee. Practically at ground level, what we are seeing is that department is generally taking the corporate guarantee rate same as bank guarantee. But now in the light of this circular, if full credit is available, then it is not necessary for us to go and opt for the bank guarantee rate. In fact, based on this circular, since full credit is available, even a nil value will be acceptable, and that should be our argument. Whether services taken at national level, like advertisement on a national level, which is not attributable to national branches, is cross-charged, is required to be cross-charged. See, whenever we are talking about advertisement, etc., we cannot say that advertisement is only pertaining at a single registration. Advertisement is always common to the entire branches, etc. Now, if you have plants at various locations, depots at various locations, then all sales, promotion, advertisement activity undertaken by you is common to the branches. So the credit of the same should either be routed through ISG or cross-charge mechanism. Now, it's a very interesting question. Another question raised for periods 17-18. 17-18 to 21-22. The time limit for availing ITC credit has expired. So the department said that full ITC is not available to branch, and hence second proviso is not applicable. Now, see, with the question raised by Rupa ma'am is that what the circular says, if full credit is available, then nil value is also an acceptable value. Now the issue is, now my litigation is going for 17, 18, 18, 19, 19, 20, 20, 21, various periods. I have not done the cross charge. I go to the department and argue, sir, since in 17, 18, I would have got the full credit, so nil value is acceptable. Now, the counter from the department can be as said by Pruba ma'am, that since for 17-18, now the time limit for availing the credit has expired, so we cannot say that full ITC is not available. Hence, second benefit of second proviso is not available. To my mind, when we read the circular as a whole, and circular specifically says that when invoice is not raised, then nil value will be acceptable. We have to give a harmonious reading to this circular. The purpose of this circular issued by the government was pursuant to the multiple investigations pending at various forums from last couple of years. So government themselves have emphasized a case where they have specifically written where invoice was not raised, nil value will be deemed to be acceptable. So to my mind, even for the past period like 17, 18, 18, 19, 19, 20, if my recipient was eligible for full credit at that moment of time, and at that time I did not have any exempted services, then the benefit of this circular should be available. Department will not be right to curtail the benefit of this circular by taking a stand that your time limit for taking the credit has expired.
With regard to the GTA query, currently the option was available for one time for a financial year, and for the new this proposal that they are providing, that option can be changed for filing declaration, that the new proposal again clarification will be awaited. In our view, since they have provided earlier also for the entire financial year, so the same position may continue even after that. If suppose some GTA has opted for forward charge mechanism and subsequently he wants to change to RCM method, so he should give that declaration, and because of that only they have provided 31st March option. So ideally it should be available for one time in for a financial year. They cannot change this option again during the financial year, and for that purpose only 31st March date is being proposed.
The next issue is, you have said that the rule has no backing for claiming extra credit. Suppose department proves supply did not pay the tax to the government, then isn't that requirement of tax actually deposited to the government written in the section not gets fulfilled? Abhinavji, you're right. Like one of the condition under section 16 is that the tax should be deposited by the seller to the government. But when we read that section in entirety, section 16(2)(c), it says that that condition is subject to section 41 and 42. So section 16(2)(c) reads that the tax should be paid by the supplier to the government subject to the provision of section 41 and 42. When we go and see section 41 and 42, they provide a complete mechanism of how a mismatch process will be undertaken at the portal. So that was based on the earlier concept of GSTR 1, 2, 3, and GSTR 1 through 3 was never implemented. So the argument which we want to take is that section 16(2)(c) is not implementable at all because that is subject to section 42, and section 41, 42 itself is not implementable because that was based on the earlier concept of GSTR 1, 2, 3, which was never implemented. So since mismatch provision was never implemented, the entire section 41, 42, Red Will Rule 69, 71 were based on the concept of MIS1, MIS2. Like there was a mismatch report under MIS1, mismatch report under MIS2. So all these are kept in abeyance. So these sections and rules cannot be implemented. Hence, section 16(2)(c) is not implementable, and that's the argument which we want to drill down before 1st January 2022. So one, obviously the rule is not backing, and your specific question that this section is there in the act that supplier has not paid the tax is actually a section which is not implementable in the light of the fact that during that period this section was entirely based on my old return system, and now if we see later section 42 and all other rules, they have now changed and brought out the concept of GSTR 2B, and all those changes are made prospective and not retrospective. Apart from that, we can always rely upon earlier VAT judgments, etc., wherein this condition was also there that the supplier should have paid the tax, and government has read it liberally to come to a conclusion that credit should be available to the recipient. It is not their fault till the time they are able to prove that they have not collated with the supplier. So if they are able to prove that I am a genuine buyer, I have fulfilled all the conditions, I have paid the money to the supplier and supplier has not deposited to the government and there is no collusion and it is not my impact, please go and find the supplier first. Try to recover the money from them first. There is no collusion and hence all my earlier VAT judgment should be relied upon. So there is a good case to argue that in case of 2A 3B mismatch before 1st January 2022, apart from the benefit given in the circular, my other technical ground remain as it is and we have good chance to fight. However, after 1st January 2022, the section has been clearly amended and accordingly it will be tough to fight. Next one.
With regard to this query pertaining to director, if the director is providing residential property on rent of 13 lakh rupees and also providing commercial property on the annual rent of 14 lakh rupees. In this case, since the aggregate turnover would exceed 20 lakh rupees, in our view, registration of director would be required.
Now the next query is, if I do cross charge of May 2023 third party invoices in June 2023, will there be an interest of 1 month? See, now we are talking about a concept of time of supply of cross charge services. That is the support services provided by the head office to the branches. What should be the timeline to undertake the cross charge? See, it is a continuous supply of services because it is provided over a period of more than 3 months. In that situation, it is not necessary that you have to do the same on monthly basis. To my mind, for all such scenario, you can have a enter into an MAU with the branches that head office is deemed to be providing all these services to the branches, and we will be cross charging on quarterly basis. Even there is an FAQ by the department wherein they have said that such internally generated services can be billed on quarterly basis. So it's not necessary that you have to bill it on monthly basis. Even to my mind, quarterly basis would be sufficient, but it should be consistent. So I think we have taken most of the questions. All remaining questions can be answered separately, considering the timelines. Over to the organizers. Thank you.
Thank you, sir. Thank you all for taking the time to be here today. I hope you all enjoy the session. I would especially like to thank to our speakers, Mr. Tushar Agarwal, Mr. Chetan Agarwal, Mr. Rajiv Khandelwal, for such an insightful session. Participants may please note, if you have joined late or missed any important information, you can watch the repeats of this session on our website, YouTube channel, and also check out to our previously conducted webinars. For any doubts and queries, please scan the code showing on the screen and to clarify them and drop us a mail. Thank you so much, everyone.
Thank you, everyone.